Hello, this is Dean Kernut, and welcome to the Alpha Exchange, where we explore topics in financial markets associated with managing risk, generating return, and the deployment of capital in the alternative investment industry. My guest on the podcast today is Eric Peters, the founder and CIO of One River Asset Management. Beginning his career in Chicago trading corn futures in the late 80s, Eric moved into the sharp-elbowed world of bond futures trading on the CBOT and then went to a bank, prop trading rates and derivatives through the 1990s. His perspective on the ERM crisis in 92 and the bond market massacre in 94 provides significant insight on the way in which policy frameworks invite risk-taking that can ultimately lead to market instability. Post the 2008 crisis, banks aren't the same source of danger as they were, but new potential flashpoints exist, and as the central banks pull away the guardrails, Eric sees a long period of adjustment to a higher volatility regime. As this new era of uncertainty is upon us, among the risks that institutional portfolios are poorly prepared for is an unexpected rise in inflation. Now, my conversation with Eric Peters. Eric, welcome to the Alpha Exchange.
Thanks, Dean. Nice to be here.
Great to have you, and a lot of interesting things for us to talk about today. I always like to get started and try to learn a little bit more about your background and specifically how you got focused on the investment industry and really specifically on the macro component of your thought process. And walk us through some of your career and how you came to start One River.
Sure. You know, when I was in college, I had absolutely no idea what I wanted to do. And it became a bit of an issue because I was coming to senior year and I just was pretty lost. And I'd seen people on Wall Street and it looked interesting from afar, but I saw people hopping on trains and commuting and it just didn't seem like it was my speed at all. So I decided that I would just go out and interview people. And so I set up meetings with someone in commercial real estate, in international shipping, the movie business, and I just sat down with them. So just like you and I are sitting down right now, I sat down with a guy who was in international shipping, and he said, "You know what? It's interesting that you're thinking about my industry. It's filled with gangsters, and you don't want to you're going to find yourself waking up in the middle of the night worrying about your ship or whatever it was." And I was like, "All right, yeah. Fair enough." I went and I spoke with a guy in commercial real estate, and his life just seemed so boring to me. You know, he was a very wealthy guy, but he just talked about, I buy a building and then I refinance it and I try to increase rents, and it seemed profoundly uninteresting to me. The movie business, it seemed very random. The outcomes are really random. So, it's obviously sexy when you're a college kid and you kind of look at it. And I went to some movie sets and I tried to get a feel for it. And it wasn't clear to me that there was any connection between how hard you worked and the outcome. Right. And I kind of looked at that and just said, wow, maybe I'll be holding a light 30 years or something like that. And then a good friend of mine, his dad was a trader out in Chicago, a very successful trader, off the floor, was in the grain market in the 1970s and brokered some of the first deals with the Russians and for grain. But he was a trader, an investor, and had a nice business. And I went and I sat with him for an afternoon. And I watched what he explained what he was doing, and I was pretty quiet. And I kept looking at his P&L. And basically by the close of the day, he'd lost the equivalent of a whole year of my college tuition. And I couldn't believe it. So he said, "So what do you think?" And I was pretty sheepish about it. I said, "Well, I don't know. What do you think? How'd it go today?" He said, "It went fine." And he said, "What are you looking at?" I said, "I was looking at your P&L. You lost as much money as my entire college tuition." And I said, "What did you do wrong?" And he said, "I didn't do anything wrong." I said, "Well, then why'd you lose so much money?" And he's like, "You just don't understand. It's, you need to follow process and you don't always know what the result will be. But if you do the right thing time and time again, you'll end up doing extremely well."
Right.
And I knew at that point that I wanted to be I didn't even know what the business was, finance, trading, but that's what I wanted to do. And I actually I'd gone through the interview process for Wall Street and, a variety of different things just because that's what you did when you were at my college. And I'd gotten into programs like that, but I just decided at that point, I said, you know what, I'm just going to go to Chicago and figure out what to do. And I'd made some money with some businesses in college. And I figured if this guy had spent his whole career and was as successful as he was and could still lose that much money in a day and feel like he was doing the right thing, that I just would never be bored.
Right.
That was it. It was like, okay, it's obviously very difficult and challenging. And I was a college athlete. It seemed like a sport really. And that was what I wanted to play. So I packed up and went to Chicago.
What was in Chicago in terms of the starting point? What position, what asset class, what was your focus on when you first began?
So I cobbled a little bit of money together from my college businesses. I was always, somewhat entrepreneurial. I bought a seat on the Mid-Am Commodity Exchange, which I don't remember. It was the exchange where people traded after hours and odd lots, basically. I may have spent $7,000 on the seat or something like that and put my money into an account. And I went to trade corn the first day because I was told that you lose the least amount of money trading corn.
Okay.
So, I was a finance economics major. I'd never seen corn before,
Right.
You know what I mean? Right. But when we went through the training program, so, and if you don't know Chicago, you probably wouldn't appreciate this, but they would just have so many people coming through these orientation programs and everyone would rent a seat or buy a seat. And it was pretty stark in the sense that you were in a room and you'd take these tests and the person speaking and trying to warn you away from doing reckless things would say, in a year, 90% of you are going to be gone. And so, I really went into it recognizing I knew nothing. And so I wanted to figure out how to lose as little as possible. And corn was the place. So,
right.
But pretty quickly I moved into bonds,
okay.
within a few months.
And so you started with this soft commodity, so to speak.
Yep.
Trading, is weather important and sort of reports on crop development? Is there a lot of technicals that go into that? And was it just futures that you were focused on?
Futures and some options too.
Okay.
There was very little customer flow. So you really kind of, I grew up trading in truly a zero-sum game where you're just in a small pit with people and you knew when you bought, hopefully you're going to make money, but
right.
someone else was going to lose money and,
Sure.
and vice versa. I was mostly technical. I concluded pretty early on that, and I would read research, the fundamental research, but I concluded pretty early on that you just couldn't cover the breadth of markets. And I liked looking at lots of different markets. Mm-hmm. And there would be no way that I could gain an advantage studying the fundamentals of corn.
Right.
But again, pretty quickly I moved to the bond market and we had currency futures there as well.
Okay. So CBOT bond futures?
Yes.
Okay.
Yeah, we were in the CBOT. Yep. We were in a little side floor. And so after that market would close, all the big traders from the main pit would come and stand in the pit next to you and you'd trade after hours. So there were times
Sure.
of lots of excitement, but most of the time we were sitting there looking at prices that were generated from the board of trade and we were kind of trading off of them. So right. It was pretty cutthroat trading.
Your time on the floor at the CBOT, when was that?
89 to 91.
89 to 91. Okay.
Yeah.
Okay.
Yeah.
So a little bit of disruption during that time period. You had we're post-crash.
Yeah.
Right.
Yeah. Or post-crash.
You had a couple of things. I remember, I want to say it was 89 was the United Airlines failed LBO, and that created a sort of mini crash in the S&P, which I assume was impactful to the bond market.
Yeah.
Tell us about, I've been thinking a lot about the 94 episode, Tequila Crisis, and the bond market massacre, as some people call it, with Greenspan's, the tightening that he did, which was very unanticipated by the market, even though he tried to tell folks, here's what's happening. And I'd done some studying of the Orange County debacle, the leveraged inverse floaters and so forth. What was sort of some of the action in the early 90s that you recall from the bond market?
So I spent 2 years in Chicago and was persuaded to go to Wall Street and join Lehman.
Okay.
So I was at a big bond shop during the period that you're talking about. And so I was a prop trader during that period. So I spent a year in New York in 91. They moved me to London just in time for the ERM blow up or debacle or opportunity. It was a really exciting period in my career. And then obviously 94 came along. And it was a fascinating period. I saw some unbelievable losses and gains during the ERM crisis, which is, more kind of 92. And we'd had the recession that impacted everyone, quite a bit, which led to the really low and persistently low interest rates, which set up the 94 bond crash. And what was, you're a young guy, you don't have any context for any of these moves. And that can be a real advantage, by the way. So in the ERM crisis, it was an enormous advantage for me that I just had no context for these moves. So for instance, I was trading Swedish T-bills at the time, and they raised overnight interest rates to 500%.
Wow. Not
by 500%. Overnight rates went to 500%.
Right.
And the French hiked rates to 50%. And so, if you have no context for moves and, probably less fear than you do at our age, you kind of look at a market with baby eyes and you say, well, if the equivalent of Eurodollar futures fell 300 ticks yesterday, why couldn't it fall another 300 ticks? You weren't necessarily grounded to this idea of mean reversion and everything. Mm-hmm. And that was a great period to not be bound by thoughts of mean reversion. But 94 was obviously different from the ERM crisis, but it was similar. And it was similar to a lot of crises in the sense that people create a mental framework for the world, and then they adopt investment strategies to capitalize on that. And as those work, they gain more and more confidence, and the returns that they can earn decline in essence. And so, but because their confidence is increased, they lever more and more. And so you'll see that pattern preceding any crisis, really. Right. But in 94, the framework that people had was that interest rates were going to stay low forever, really. And so the leverage that was built up then, at least the leverage that I really saw at the floor of Lehman, was in the structured note market. And so what people would do is you'd have salespeople that were dealing with, I'm going to make it up, but Dutch pensions, I'm not making it up, and various banks that were not terribly sophisticated, but I'm sure were compensated based on what types of yields they could generate in returns and whatever. And so they just started buying because yields were so low, and they're obviously a lot lower now, but at the time they were incredibly low, 3%. And people thought, if they're going to be here forever, I got to figure out how to make more money. And at the time, a structured note would pay you an incremental yield, let's say an extra 5%, as long as Fed funds rates didn't move 50 basis points higher or lower over the next year. And, as more and more money flowed into that, those ranges compressed further and further. And I remember in the beginning of 94, the economy had clearly been warming up and heating up, but we had this blowout jobs number. And I remember looking at the guy next to me on the desk and said, that's something pretty extraordinary. And then just all hell broke loose.
So as you describe that situation of, one, thinking something's going to be sustainable forever, and sort of the confirmation bias of it actually happening for an extended period of time. And then I think what you were saying is there was a lot of optionality sold, right? Correct. So a lot of these inverse notes and floaters and so forth effectively sold optionality to the banks at probably sub-market rates.
Yeah.
The Orange County one is fascinating. You get this guy he's sort of viewed as a genius, this Robert Citron, and this vehicle that he had is an interesting vehicle in the sense that other counties are giving him money to manage as well. And he's putting tremendous amounts of leverage on with these, hold to maturity instruments, and then repoing them to get more leverage, and feels like just got marked out of it. And what's so interesting is that this wasn't an age of email. They didn't really have email.
Yeah.
And so I read one of the books on this meltdown from Orange County. And one of the things that happened was the Merrill salesperson, who was very active with Citron, their risk department started looking more closely at the trades. And then they were sending him memos saying, we want to make sure that your duration is not 3, it's actually gigantic, right? Because you've got so much leverage and there's 2 times and those types of things. Really an amazing situation. I wanted to go back to ERM because I hadn't thought too much about that, but Druckenmiller's been doing the rounds. He just put that op-ed piece out with Kevin Warsh on suggesting the Fed should basically go slow from here.
Right.
But ERM's so interesting. I thought you might comment on this. It was a developed market country, the Bank of England, effectively crying no mas, right? They had something that was ultimately became viewed as just unsustainable, right? Are there equivalents to that as you sort of think back in the last 20 or 30 years where a government construct of some kind of financial construct, is there something like that this reminds you of where, market forces push so far one way where even a developed country, I'm not talking about Iceland abandoning the krona, I mean a developed country. Is there something like that we've seen either in FX or in some other asset class where the government, sort of unenforces something that they had been enforced? Maybe it's the Swiss franc, right? Or was it early 16? Is that maybe an example?
It's an example, but it's just much more limited, right? The ERM was an interesting construction, and you understood why it was put in place. It made some sense, but it had this, like all these things, do they have a reflexive feature to them? And so, Soros used that to his advantage when it was ready to blow apart. But you tried to set currency exchange rates in a really stable way, and in a sense hoped that everything else would fall into line, and that different policymakers and governments would adopt the right policies to keep things in line. In some sense, it was like the euro today, except it was looser in that it could be broken apart more easily.
I see.
And so it's not terribly different from the euro today, though, in certain respects, right? You kind of, everyone locks themselves in an exchange rate regime, and then you hope and pray that people make the right decisions to make sure that the economies are reasonably well synced up and can handle the fact that you're all using an exchange rate that's stable.
Right.
But what happens, so that's the economic side of it. Then there's the market side of it. And the market side of it is that everyone's looking to make a buck. And if you understand what the rules of a game are, you start playing it. And in the case of the ERM, people looked for all kinds of ways to earn carry by betting that this system would remain stable. But once once economies diverged far enough and inflation rates diverged far enough, which inevitably they did, it created real stresses on the system. And so you ended up with really large pools of capital that were betting that the system would remain intact. And like anything, once you have enough people all betting the same way and they're levered, they become extremely vulnerable, and the system becomes fragile. And so, I think Soros and a number of others did recognize that at the right time. By the way, there were plenty of people that recognized that too early and, would bet when exchange rates would go up against certain bands, they would bet that it would break out and it wouldn't work. So it certainly wasn't an easy bet to make, but he did a terrific job in making it the right time and the right size. It
sort of reminds me of there was no shortage of people betting against housing or subprime securitized paper in 2004, 5, 6. And Paulson comes along and just, not to take any credit away from him at all, but the timing couldn't have been any better. The sizing was tremendous. And it's sort of the equivalent of someone that got something right that a lot of other people had taken a shot at, and some were successful, but his timing and his sizing was just spot on.
Yeah. There's always going to be someone who makes that bet, right? In the size that he made it. And, who knows if he'd done it a little too early or a little too late, certainly a little too early, it could have just been bankrupt and you never would have heard of him.
Exactly.
But, that's always going to happen.
When we think back in the 90s, you've got ERM, you've got the bond market massacre, you got the Asian contagion, LTCM, the Russian default. Pretty strong decade for big macro unwinds. And what were sort of past the bond market meltdown in 94, the next 5 years, how did any sort of, as you think back on either Asia in 97 or LTCM, obviously tremendous amount of swap spread movement through the LTCM unwind. My portion of it, I was in equity derivatives at Lehman, and the movement higher and long dated equity vol was nothing short of a gigantic squeeze, all of them, just short, more Vega than you could have ever thought a fund could be short. But of course, the swap spread widening was a big part of that as well. What were just the last, as sort of the 90s got round out, any things that you think back on that were truly impactful, lessons that you learned from your own prop trading?
I think the 90s were this unique period, right? Because you had Greenspan in, and I think the way to think about the 90s is to think about it through the lens of Greenspan. So Greenspan took over from Volcker, in the late 80s, and he seemed to apply the same logic and thinking to each of these series of crises that came about. And I think that the whole world watched that and just adopted those sets of behaviors. The U.S. has, as a reserve currency, the most latitude to make these big monetary policy decisions. Other countries, weak countries, can't do that, or they completely implode. But I think the 90s was that period where you had these crises and you had everyone begin to adopt reasonably similar responses, and they became more and more powerful through time. And I think policymakers were probably believing that they were becoming more intelligent about how to manage markets, and I don't think it worked out terribly well for them. But I think that's when I think about how those crises unfolded, that's what you had. And then as once you got through the .com bubble, and you had extremely low rates again. I mean, you kept pushing the boundary,
yeah.
But the bubbles, because you had this series of crises during that period of time, those who got burned wanted to make decisions to try to prevent those. So, Asian and global central banks looked at what happened in Asia and just said, I never want to be in that situation. So a lot of dollars were accumulated, and, Greenspan was, in a sense, happy to supply those dollars. So you kind of, with each one of those crises, you built up buffers that made them less likely to appear, certainly in the exact form. And then we ended up with, the monster bubble in housing, which is, in a way, kind of the place that people least expected it. You saw all these crises in these small countries and far-flung places, but U.S. housing is, you wouldn't have expected that would have been the bubble. Or certainly they wouldn't.
It's interesting, the post-tech bubble unwind and this view that we were entering into this period of at least disinflation and maybe more foreboding deflation, and Greenspan was worried. And so the insurance policy seemed to be very, very low short end rates, incredibly steep curve. You point out in some of your writing that we've seen policymakers make just tremendous forecasting errors, that we should be humble by what we think is going to happen, even with the most data and all the PhDs. And one thing you point out is in the late 30s, the view that we were entering into a period of stagnation and disinflation. And then a couple of years later, as we entered war, 10% inflation, right? Yeah. So, sort of put that as shit happens, right? And with Greenspan, curious, as you think about the period leading into the 2008 meltdown, what is that set of ingredients, and how do you weight, the different inputs into how did we get there? Right? We look back and we see some things that were, again, in hindsight, we're 10 years in hindsight now, remarkably fragile, staring at us in the face. Our old firm, Lehman Brothers, its CDS was trading at 20 basis points with a gigantic amount of leverage, illiquid assets, and the most convex thing you could possibly own at the cheapest price we've ever saw. It's just such a paradox.
Yeah.
As you think about the period, let's say post the tech bubble leading into 2007, how do you score the different inputs in terms of the being impactful for getting us to where we ultimately got to?
Yeah, that's a good question. Low interest rates are extremely powerful, and the profit motive is extremely powerful. And there's almost nothing more powerful in finance than the appearance of a one-way bet that works for a while, right? And so in every cycle, you see that the dominant investment strategy, and I say dominant, the one that's performing the best becomes the dominant investment strategy. And then it kind of attracts all the assets and self-reinforces for a period of time, until it fails, right? And I guess what was just so remarkable about that period is that this reliance on low rates and this growing confidence that the Fed had a lot of control over the real economy. It seemed to just line up perfectly behind housing, and housing hadn't had a big crisis in a while. I mean, housing has had plenty of crises over the last 100 years, but it just hadn't in a while. And so I guess it was just its time.
Right.
But all the other things really fed, right? You had all the different Asian and global central banks that wanted a lot of US paper. And so, one of the interesting lenses through which I think you can almost look at the US housing crisis is there was so much demand for US paper globally, and the Fed had kept rates so low and dollars abundant. People just needed places to put dollars. And, lo and behold, the market created an amazing supply of assets for them to buy that were reasonably liquid, which were these mortgage bonds. And, so each one of these things look different, but I think all of those contributing forces, which were, responses to previous crises where, central banks wanted to accumulate dollars, and the Fed became ever more confident that it could control markets. And certainly all the policymakers never wanted to repeat the chaos of things like any of those other crises, but the ERM, because I think, central banks, when they lose control, it's extremely ugly. That's the last time we really saw major central banks really lose control, I think, was the ERM. Markets lost control in 2008, but the central bank stepped in, and there was a period of time where there was skepticism around their ability to put a floor under things. But eventually, wasn't measured in years. It was pretty clear that they were able to put a floor under things. But yeah, policymakers never want to really lose control. So I think all those things contributed to 2008 becoming just such a massive crisis.
Right. So your time at Lehman, when did that take you through? And then what was your next stop after Lehman?
I was Lehman till about 98, I think. And then ultimately I ended up starting it's a more of a distracting story. I started a finance company during the .com period, which is kind of an interesting company. And then spent about 5 years with that, sold it in 2003 or 2004, and then kind of reinserted myself back into actual trading and investing, and then ultimately made my way to a hedge fund in California where I spent 4 or 5 years. And that kind of took me through the 2008 crisis. But we really kind of got going got seated in September of 2008, right as this was all unwinding, which was ironic in a way, as Lehman was failing. But yeah, and so I've just been in hedge funds ever since.
As 2007 was occurring and then into 2008, as you think about the risk philosophy that you brought into that crisis, and then the way in which it may have been shaped, influenced, further substantiated by the crisis itself, what did you see going in? And when we think about September 2008, or I guess it was November of 2008, VIX of 80, never seen things like that before.
Yeah.
Credit spreads, just never seen anything like this before.
Yeah.
Banks going under, TARP,
right.
The kitchen sink of rescue facilities all conjured up out of thin air, some of which worked, but took a long time.
Yeah.
What was your experience through the crisis, both just observing the wheels falling off the bus and then just managing P&L and looking for opportunity and trying to avoid the landmines?
I think, so I took a role at a hedge fund in Cali in 2007, and the firm, it was actually quite a large firm. It survived 7 months after I joined. So I was a PM there, and it was one of the first firms that was consumed. It had a mortgage trading arm. It was one of the first firms that was consumed by that crisis, pre-Lehman, but early in the whole mortgage blow up. And that was, it was amazing, really, because it was my first glimpse into what hedge funds are able to do and how they're able to get leverage. And I wasn't really attuned. I wasn't part of the mortgage group, but I, could kind of see it from afar. And the type of portfolio they had was, levered at a reasonable rate given the time when there was no volatility. And the moment there was a little bit of volatility, the wheels came off and credit lines were pulled. So, it was right in that early period. And I felt like, to me, it was just deja vu. Because I've grown up, I guess, starting in the commodity pits and then going through things like the ERM and these various crises, I've been really the opposite of a levered carry trader my whole life, because I've just seen too many fiascos happen as a result of that. And I think that those will continue to happen. They just always will happen. And there'll be different tools to try to help mitigate the fallout. Or there might be regulations, and there are regulations to try to prevent that. But, that's what happened. So when, as 07, 08 was unfolding, it just seemed to me like it was going to be a rolling train wreck. And I think housing was a pretty obvious bubble. But like all these, you don't know when it's going to roll over. But I saw a lot of people in the same types of trades that I've seen in my whole career. They convince themselves that the world is going to look the same tomorrow as it did yesterday. And they become extremely levered to that. It becomes the dominant investment strategy. And then something changes and it's all over.
One of the areas of The Big Short, the book, that is described is a trader from Morgan Stanley, Howie Hubler, who had the subprime trade very right. He owned protection, was paying out a decent amount, and was waiting it out, but had a very large book. And ultimately, and this is unfortunate decision for someone that had the trade right initially, but stepped back and said, if I kind of sell off some of basically turn my put into a put spread, and he sold super senior protection, wound up with like a 1/10 type put spread, where you step back and, as you're noting on the mortgage side, you just get to outcomes that are so far away from anything you've experienced before. So he sold a lot of super senior protection to finance this carry that he was burning through, waiting.
Yep.
And ultimately, because this thing got so severe, I think the number was $15 billion he lost after having had the trade right. And he just had sold this upper tranche protection in such size that when it got there, it just was nasty.
Yeah. That's the California firm that I joined when I first went out there. It had a similar structure. It was a relative value trade. It was the right trade. It was long a few senior, 3x the senior and short triple Bs and levered. Right. And it did incredibly well in 2007.
Okay.
And then early 08 just blew up. But it is always that way. Mm-hmm. It really is. It's amazing, but I think the comp structures in the industry and just human behavior all conspire for those patterns to repeat.
So that's an interesting point you make around comp structures. Folks, the way in which people are motivated, right? Their decision-making process, selling optionality and getting paid now for something that might blow up later. The other thing you mentioned was on financing. Get your financing pulled, right? Bear Stearns, just in a couple of days, your repo lines are cut and that's it.
Yeah.
And so my question is around the comp side of things, because there's been a lot of Wall Street focus on how people are paid, right? Try to not give them so much optionality, hold back comp as a way of influencing behavior. And then on the repo side, the funding side and the fragility that comes from funding every day overnight. When you, again, post-crisis, you step back and you look at the types of things that have been done. And you mentioned Volcker Rule, some of the leverage ratio initiatives from the Fed to try to reduce bank leverage, the way in which people are paid. Wall Street was the center of that storm in a lot of ways because the banks had so much leverage. When you step back and look at the kind of landscape of risks now, is it fixed well enough in your opinion? We'll never know. But when you look at the clamp down, so to speak, right, the reaction that we saw in 2010, 12 and so forth as DoddFrank was initiated, do you feel like these new regulations and new oversight, is it effective? And when you think about the banks themselves, are they a source of fragility in any way close to what they were? Are there hidden risks?
Yeah, I think that the clampdown has been effective in addressing the last crisis, which is always the case, or almost always the case. But if I think we've learned anything over the last our entire career. It's that the market conspires to provide the narrative and the opportunity and the inputs to create outsized returns in some, in something that attracts enough capital that creates another problem. And I think humans are just too creative to think that, a handful of regulators or an army of regulators, for that matter, responding to something that had seemed unimaginable and then actually occurred. That people are too creative to look at the new regulations that have been put in place to prevent that from reoccurring, to not find something else to do and get themselves into trouble with.
Right.
It's just human nature.
Yes.
So, when you look around the world, or when I look around the world today, it's pretty clear that there are all kinds of different ways that leverage have, and has popped up, and all kinds of, I would call them misbehaviors that, in games that people play. And I don't, some of it's comp driven for sure. A lot of it's comp driven, but it's also, I think, driven by people's desire to want to believe in something. And so, I don't know, when you look at corporate buybacks, it seems to me like that's a real problem, right? And it's something completely unanticipated. I would say broadly unanticipated by policymakers when they adopted QE, that all this liquidity would go into vast buybacks and not into capital investment, broadly speaking. But it's propelled a stock market that's probably made every single CEO and CFO who's decided to do buyback feel pretty smart and feel wealthy, and their comp structure supports that, and they don't feel like they're being dumb because their shareholders in their minds have been rewarded. So it's not just all bad actors, but I think when you want to believe something badly enough, humans figure out how to believe it. And sometimes those things that they believe are awful. Sometimes they're wonderful,
right?
And when it comes to finance and speculation, they tend to be things that can deliver enormous profits that are really outsized to what an economy should be able to deliver.
Yeah. The rules of the game, so to speak, that I would say the central banks are most responsible for setting up. They're creating the conditions of carry. And this last cycle has been such an interesting one in the low rates and low vol, right? We've never seen that coming together in the degree to which we've seen it here.
Yeah.
Before, I want to get a lot of your perspective on that. I'd love to hear your thoughts on the sovereign crisis in Europe, the one that really was a rolling crisis from 2010, I think, is really when things started. I remember the flash crash in 2010, and people were so confused because there was on TV riots in Greece, and you just didn't really know what was the proximate cause of this. But it really got going in 2011 and through 2012, probably the middle of it. Draghi has got his famous "whatever it takes" commentary. But I'd love to hear your thoughts on just developed market sovereign bonds being caught up in something that felt very reflexive at points in time. And they really didn't know how to put out the fire. At least they didn't have either the wherewithal or maybe the right philosophy. I don't know. What are your thoughts thinking back on that period?
The euro and that whole region is just so interesting to me. We could talk about it for long time. But specifically on this point, I think one of the big challenges that Europe has is it has a common currency, and it just does not have a common, budget, basically. And when you think about what that really means, it kind of means that Europe is on a gold standard. And so financial professionals, all of us doing this, at this point, none of us have seen a gold standard.
Right.
You know what I mean? So when, I think that this whole business requires a decent amount of imagination, certainly if you're going to try to capture market inflections and things like that. And usually when a big opportunity happens, it's because there's kind of a collective lack of imagination about kind of how things could look differently, and or people are so incented to just bet on a continuation of a trend. And so there was such a long trend in place. And I remember when it started, but that trend in place toward the narrowing of interest rate differentials across Europe. And it got to a point where you were paid virtually nothing incremental to invest in Italy relative to Germany. But it's just because, that trend had been in place for so long and there was a lot of leverage behind it, and people made a lot of money, and then it almost became kind of sleepy, and it just became a kind of a common myth that all these bonds were the same because they had the same currency, and they really weren't. So, I think ultimately what happened is, there are a lot of different ways, I guess, of looking at the crisis, but ultimately what happened is you had all these countries that had a common currency, but just didn't have the ability to print it. And so that's a goal. That was what happened more frequently, when you had a gold standard.
I'm thinking back to the early part of 2011, and Trichet was the head of the ECB. I think he tightened policy in May or June of 2011. This is a hypothetical, rhetorical type question. Do you think with different leadership at the helm at the ECB front, do you think things would have been a lot different if there was a bit more of a, Tim Geithner sort of kitchen sink philosophy, ask questions later, throw everything you can at putting out the fire, because if you don't, it's going to be really, really difficult. Ask the questions on moral hazard later. Europe seemed to be very tepid in its response. They were, I don't want to say anti-market, but very skeptical of the short sellers on the euro. And they just didn't seem to have enough firepower, either because they wanted to or maybe just couldn't get organized. Do you think about it as a central banking mistake, or is this was going to happen regardless of the philosophy that they approached it with?
Well, I think that the Europeans make lots of central banking mistakes, but I always really admired the Bundesbank. Just their fiscal and monetary prudence is something that I just, throughout my career, I admired the fact that they seem to take the position that, look, let's just kind of create honest money and then let the economy organize itself around the strength of money. But it's very different from the other Europeans. In Italy, the Italians had kind of the opposite view. It's like, well, let's play with money, and then let's let people organize their businesses and wages around money that is less meaningful. And so, but I think the problem that the Europeans have always had internally is that they can't agree on how sound money should be. So the Germans basically worked with the French to just say, okay, we're going to control this and keep everyone in line. But then the real issue is, even if the Europeans can agree on what money should be and interest rates and how that all fits together, they have a problem because the global reserve currency is the dollar. And so the Europeans have always been kind of caught between wanting to be austere in one way, but they can't be too austere if the US is going to, be run by people like Greenspan and Yellen and Bernanke. They just can't do it, because Europe is kind of chasing the US around.
Right.
If Europe were dominant, they could control the world. They could set the tone, and the US would have to follow. But so I think the Europeans often get themselves caught in that situation where they go, you know what, we don't want to be like the Americans, so we're going to hike rates, and it ends, late in the cycle, and ends up being the wrong thing to do. So I expect, I think there's some cultural reasons for that. The Europeans don't want to have to be led by the Americans, but in monetary policy, they just are, and that leads them to making errors. Yeah.
So we've seen some pretty good vol in Italian sovereigns this year. There's concerns around budget deficits and new leadership. France has had its riots. The European economy seems to be slowing. When you look at your mosaic of things that you're worried about, or that can be a flashpoint for risk that is broadly experienced by markets globally, where does Europe sit right now for you?
Not terribly high.
Okay.
I think there's a very real chance that the euro looks that it just is a passing phase in Europe's history, but it doesn't seem like that time is upon us right now. And I think that they're just bigger conflicts and problems in the world. The relationship between China and the US is just much more interesting to me right now. I think you have to absolutely pay attention to Europe, and I assume that they're going to make a whole series of monetary mistakes over the next year or so. It's hard for me to imagine that having interest rates set at negative 40 basis points isn't an enormous monetary mistake already, but it doesn't mean that it has to manifest immediately. I think the bigger conflict is just what's happening with the US and China right now.
What are your thoughts on there?
I think that probably the most remarkable thing that's happened in the US over the last 2 years of Trump's presidency, and there have been a lot of remarkable things that have happened, but I think the most remarkable thing has been that we went from, I would say, a broad American view on China as being, it's kind of dependent on who you asked. If you asked most people on the street, they would say those are the guys that make my flat screen TVs and my cheap toys and what I really care. And a few people say, well, it's going to be China's century, and no one really knew what that meant. Every business leader who I spoke to who did business in China would tell me off the record that they're incredibly frustrated because their IP is stolen. They're forced to transfer IP through production agreements. The list of angst that corporate CEOs had was extremely long, but they couldn't say anything about it. And then the military context that I had were also incredibly frustrated because they said, look, China is building up the South China Sea and fortifying these islands and putting military hardware on there. And we're basically just ceding control of that whole area. And that's a really big deal. So 2 years ago, that was kind of state of the play in the US. And in 2 short years, I would say that virtually every constituency in the US now views China as a rival, an adversary, a real rising threat that needs to be contained. It's remarkable. When you step back and you think about history of conflict, you really don't want to get in a big fight with 330 million Americans. You just don't want to do it. And we're gearing ourselves up for a fight.
When you look at the market disruption, let's call it, we were talking about earlier, it's not, VIX isn't at 50. We're falling, consistently markets are losing value, but it's not chaos, as it were. How much attribution do you give to the forward-looking uncertainty around China, maybe what companies are already reporting as, hey, this tariff uncertainty is impacting our business and our ability to conduct our strategic goals? What weight or an import do you ascribe the China conflict to, let's say, the last couple of months of market downturn?
It's hard to assign something. It's part of the puzzle.
Part of it.
My experience has been in speaking with very large allocators, and I always find those conversations really interesting. But also other guys who manage money directly for a living, is most people really have a hard time making any investment decisions based on geopolitical concerns. And the trade stuff kind of falls in between, right? You could talk about a hot conflict with China, and I think that that'll be a risk that we'll face over the next decade. I have no idea how to time that or think about it. I just know that it's a much greater concern to me than the Germans and the Italians getting in a pissing match with each other.
Right.
But the trade stuff I think fits within that, and I suspect that the market is beginning to come to terms with this idea that this China-US conflict is about a lot more than a trade deficit. And it's more of how do you go from a unipolar world to a world where the US and China have to figure out how to live with each other and trade with each other. And so it's probably going to be quite a bit more protracted. So I'm sure that affects asset prices. But the real thing to me that's affecting asset prices is just, look, we had 10 years of QE and unbelievably low rates, and the US is getting out of that business, or is desperately trying to get out of that business right now, even in the face of a president that's trying to tell the Fed to not get out of that business right now. But I mean, that just shows you, by the way, how badly they want to get out of that business to give themselves more latitude in the next, downturn. And Europe is hopelessly stuck in this period. You talk to investment people in Europe and you go, where do you think overnight rates will be in Europe in a decade? And they literally can't even imagine they'll be anywhere further than 50 basis points either side of zero. So like Europe is stuck in its mess. Japan is kind of stuck. No one has latitude to do anything other than really aggressive QE or print money and give it there aren't many levers left. And so I think the market's starting to sense that from levels that were very overvalued.
Do you think that the period going into this, 2017, lowest realized volatility in the S&P since I want to say 1963, 50-something years.
Yeah.
The VIX closed below 10. I want to say it was 52 times. And yet it was a great year to sell vol. We know the XIV.
Yep.
A lot of your thought process on markets pays, I think, careful attention to carry trades, the consumption of trades that continue to work that are done at increasingly maybe more fragile prices, and then ultimately become part of the dramatic moves, right? Because there's a buildup along the way.
Yep.
We've talked a little bit about low rates and low vol, Fed induced, maybe other central banks are a part of it too. They're in the asset buying game even more so still. What are we seeing in 2018 in terms of, is it the reckoning of we brought asset prices to a certain level, and as the Fed gets out of that game, is that what we're seeing now? And is this a precursor to just an ongoing process? Is there much more to come from your perspective? We never should think about a 2008 financial crisis as around the corner. It seems pretty a remarkable event, but there's plenty of ways for the VIX to get to 30 and 40. What's your severity meter look like as you sort of think about the level of fragileness?
It's been pretty remarkable that the VIX has stayed as muted as it has in the last couple months. It's interesting. You never know exactly why markets move, I think. But in terms of overall fragility, I think that there's a lot of built-up fragility that's just not in the places that people are looking, which is generally the banks, just because that's what happened last time. I think that, and consequently, I think that this whole market environment that we're in I think it just has years to run. I think probably has, a decade to run more. I know that sounds like a long time, and I'm not trying to predict the future that far out. It's more that I think we're in a inflection point. So let's talk about the markets really quickly, and then the politics behind it. So 2017, you described really well. I would just describe it even more simply, which is that you had muted economic growth, you had extremely strong asset price returns, and you had an absolute collapse in volatility, something that maybe you see twice in a century. And what do we have this year? We have extremely strong growth, economic growth relative to what would have been expected. And we have had very muted to negative asset price movements, right? And vol has had some episodes. So when I look at that, it looks very much like a transition year to something that just looks very different. So why would things look different? To me, it's almost, it just seems very obvious, but we've had a number of trends over the last few decades that have led us to a point and some of those have been increased globalization, deepening of global supply chains, wonderful technology that's connected the world, lowered costs, made it very easy for corporations, in essence, ultimately made it very easy for corporations to shift the mix of the profits that went to capital relative to labor. And by the way, it's been enormously supported by government policy and central bank activity. All of these things kind of got us to this point where we've started to see some real political shifts, and not just in the US, but obviously in the US, in Europe, in the UK. I would say Abenomics is a version of this. They're just, they've been stuck forever, and they just said, we got to get someone in who's going to do something different. He came in and he's like, all right, let's do Abenomics. Now, it hasn't worked great, hasn't been a disaster. And they probably will become more radical still at some point. Maybe they'll have to become less radical, or maybe they'll have to tighten a little bit, and then they'll have to really blow it. I don't know. But what I would say is that it seems extremely evident that we have gotten to a point where the economic pie was divided too unequally, and people have just said, I'm done with it. And so even you get a guy like Macron who comes in France, and he wants to throw the love embrace around Germany and just say, we're going to all unite. He tries to raise taxes a little bit, and the little guy just says, forget it with, the yellow vest protests. So I think that the reason that we're at a point of fragility is we've just gotten to one of those, extremes of the arc where the pendulum will swing back in the other direction. And consequently, the policy decisions that we made and the trends that will spark will impact things like inflation, that will impact correlation. It's already increasing budget deficits. I mean, look at what the US is doing in terms of bond supply. So as those things change, I think any investment strategy that was built for the last 10 years will face a whole new, it doesn't mean it will be terrible, but it'll face a whole new set of challenges as you look out over the next 10 years.
You mentioned inflation, and I know that your team at One River is developing an inflation product.
Yeah.
It's been an asset class that's not delivered very much for very long periods of time. And in some ways, one of my things I repeat to myself sometimes is the next crisis is going to be the one that's occurred longest ago. And we haven't seen anything resembling uncomfortable levels of inflation. And we certainly have convinced ourselves, or guys like Larry Summers have convinced us, that this is it forever.
Yeah.
Whether it's demographics, this concept of secular stagnation, technology, globalization, that's it. We can't increase inflation. Tell us about your product and sort of the way in which it's supposed to position within an institutional portfolio.
Yeah. So I won't go and pitch our product too hard, but inflation has been extremely low and stable for a long period of time. So core PCE has been kind of between 1% and 2% for the last 20 plus years in the US, a few months outside of that range. And so rightly, institutions have not considered it as a big driver of their investment process and decision making. But if you think about what impacts the price of everything, securities included, and they're very sensitive to inflation, it's a huge input that no one has had to consider. And so almost by definition, what you know is that every institutional portfolio in the world is de facto short inflation because and that has not been the wrong thing to be. But if you believe what I just described as, the world being at an inflection point, and again, to me, that seems very obvious. If you want to remain short inflation, then you need to bet that all the political changes and the policy changes will just be dwarfed or just be completely ineffective or disingenuous. In other words, leaders get in saying, I'm going to help people, and then they're not. And we'll continue to have inequality or widening inequality. But if you believe those trends are in the process of shifting, you better not be short inflation. Inflation doesn't move in a straight line. It never has. It doesn't. Like any market, bounces around. But we think it will become more volatile. And so we're building a product that can capitalize on increasing volatility and inflation, both up and down. So that's the goal. And it's focused on a whole category of securities where there just aren't many people that are extremely skilled in that. And we happen to have Lindsay Politi on our team, who has spent her career dedicated to inflation trading and is, an expert in that field. So I think that will be an important consideration for people in their broad portfolio construct, to think about how inflation will impact it. And we've spoken with a lot of big investors about that. Our product is more of a bond replacement product that should thrive in a period where inflation starts becoming more volatile. But you mentioned the 1960s is a really interesting parallel that we see. And I like parallels, but I don't become wedded to them. But you mentioned that volatility was extremely low, in 2017. The last time was the 1960s, right? There are a lot of parallels. So 1964, you had an environment in the US where the big angst of the day was people in the cities were making a lot more than people that were being left behind in the countryside. Amazing. You go back and look at that was the big issue. The question was, how is government going to try to solve that? They did a huge tax cut in 1964. Actually, like all tax cuts, they went to the wealthiest people. But they thought, a little bit of trickle down. If this gets the economy going, we run hot for a while, it will draw more people in the city. They didn't know what the Phillips curve was because it wasn't invented. That it kind of was invented or named, following that period. But they thought, let's run the economy a little hot here for a while, and hopefully we can suck people in, get people paid more money. So inflation had been very low and stable for a long period of time. Productivity was incredibly low too. And why was it low? It was low because you had huge productive capacity that came in from World War II. Corporations didn't invest for a decade or so after that. And so you had really anemic productivity gains. And so you had a lot of the same problems that we had here. There's some different population dynamics and demographics and things like that. But there are a lot of parallels. And anyway, inflation started creeping up. The Fed was okay with being behind the curve, kind of like I think they will be now. They then made some rate hikes. The stock market had a deep dip. Rates had headed higher. They turned around and they said, oh, God, and they cut rates, but they were behind the inflation curve the whole way. And then once they did that, asset prices jumped up again. And then that was kind of it. Then it was just checkmate through the 1970s for nominal asset price returns. It was very volatile. Nominal prices didn't really go up. Real values went down a lot. And so, maybe there's something like that. But it's interesting when you see things like vol being so low, or the trend strategies did generally very muted gains in the 1960s, like they've been muted over the last decade. And then they had the best decade of the last 150 years in the 1970s. So it seems likely to me, or maybe put it differently. I don't think you should bet on another decade like the one we just had.
Right. Right.
Like, why would you?
Exactly. You mentioned inflation and the vulnerability that portfolios have to it. I would just concur in my own conversations with pension funds and state funds, other sort of long-term investing types. I'll hear very consistently we're exposed to a simultaneous, and maybe this brings in correlation as well, a simultaneous increase in bond yields and fall in stock prices, right? And that inverse correlation has been a real characteristic, certainly of the post-crisis era. It really started maybe even post the new century, where stock and bond prices became so negatively correlated. And I think when something happens for long enough, it just becomes viewed as semi-permanent. And I'd say that an unwelcome increase or unexpected increase in inflation where the Fed's just chasing, boy, that sounds like no one's really prepared for that. Mm-hmm. And so I think the product sounds really interesting.
Yeah.
Well, we'll leave it there.
Okay.
I'm grateful for your time, Eric. It's great to have you and your insights across different cycles and present day as well. So thank you very much.
Dean, that's great. Thank you. Appreciate it.
You've been listening to the Alpha Exchange. If you've enjoyed the show, please do tell a friend. And before we leave, I wanted to invite you to drop us some feedback, as we aim to utilize these conversations to contribute to the investment community's understanding of risk. Your input is valuable and provides direction on where we should focus. Please email us at feedback@alphaexchangepodcast.com. Thanks again, and catch you next time.